In this video, I shall be discussing bank loans. Let me note that I have no training in banking or economics. What I'm presenting here is based on some reading and some thinking about what I've read. You walk into a UK high street bank, such as NatWest or Barclays, and they agree to loan you a sum of money. Where does that money come from? Take a moment to consider that question. If your answer isn't the bank creates the money that it lends to you, then you're wrong. Chances are you are thinking about getting a loan from a different type of financial institution, like that described by George Bailey in It's a Wonderful Life. That money from savers is channeled to borrowers through a financial institution. That is, an institution that has to borrow to loan. These may also be called savings and loans or building societies, and I'll refer to these collectively as investment banks. Savers invest in the bank, which loans to others. Before moving on, let's look at a few details about these institutions. In this diagram, we see there is a certain amount of money floating around looking to be invested. To attract that money, an investment bank offers an interest rate to a saver, but of course is in competition with similar institutions for that money. When the bank loans that money to a borrower, it must charge an interest rate that exceeds that available to savers in order to cover operating costs and possible profit. Each institution decides what the saver's rate should be based on those market forces, although in reality the major factor is the Bank of England base rate. Why? The Bank of England states that the base rate is what it would pay for money saved with it. According to that description, the bank would be part of the market, and so its rate would influence the rates of other savings banks and building societies. However, the hole in that argument is that the Bank of England's savings facilities are not available to ordinary savers, only some other types of financial institution. If that is so, it would seem that it is not a necessity for savings banks to increase or decrease interest rates according to the Bank of England rate. Of course, the second one savings bank changes its rate, others will need to follow in order to retain or attract more money to service its loans. It seems more like the Bank of England rate changes are taken as a signal to the savings banks about what is acceptable. It has the feeling of an inadvertent cartel directed by the central bank. Anyway, we're really here to consider the banks that create the money that they loan out, which we'll refer to as commercial banks. So let's get into the details of their operation. Consider a person, A, who approaches Alpha Bank, one of these commercial banks, for a loan of £1,000. The bank agrees, and as a result creates two accounts for A. One is in credit to the tune of £1,000, and the other is in debt to the same amount. Person A takes the loan and uses it to buy some raw materials from person B, transforms those raw materials with their own labour and sells the resulting products to person C for the sum of £2,000. A then deposits that with Alpha Bank and then uses some of that to clear the debt, thus destroying £1,000. However, the final amount in A's credit account is only £950 because the bank has levied a 5% interest rate on the loan, and so Alpha Bank has made £50 for itself as a result of this economic activity. In my tax video, I said that money is a true catalyst for economic activity, and we can see that at work here. The bank created £1,000 that stimulated economic activity involving A, B and C. Once that had been completed, the £1,000 is destroyed. So from the modern monetary theory ideas discussed in the tax video, this seems to be a good mechanism. Are there any negatives to this mechanism? Well, one issue is that it is the commercial bank that is making decisions about where to deploy the money it creates, and they clearly have a financial interest in the outcome. That might be considered a conflict with the needs of society at large. This is the thesis of the book Modernising Money by Andrew Jackson and Ben Dyson, and we'll come back to that in a bit. My other issue with this mechanism is the interest charge made by the bank. Let me explain. Consider the situation where the loan is for £10,000. In this case, the bank now gets £500 in revenue from the loan. Why is that a problem? This time, person B supplies 10 times as much raw material as before. Person A does 10 times as much work as before to create their product, and person C pays 10 times as much for the final product they receive. This all seems fair enough, but the bank also makes 10 times as much money, but since it is creating the money, all it has done is type an extra zero into a spreadsheet. 0.25 as much work compared to the £1,000 loan. How is this possible? This is a fairly simple example. Maybe there is something in the way money moves around the banking system that justifies the use of an interest rate on a commercial bank loan. Let's look at different possibilities. First, A, B and C all bank with Alpha Bank. In this case, there is no justification at all, as this is all internal to the bank, so very little extra work compared to the original situation. What about if B and C bank with a different bank? In this case, when A pays B, money must somehow end up in B's account with Beta Bank. This could be achieved by Alpha Bank asking Beta Bank to credit B's account with £1,000, but now Alpha Bank owes Beta Bank £1,000. How does Alpha Bank make Beta Bank whole? It does that using money held in its Bank of England reserve account. Alpha Bank requests that £1,000 is moved from its reserve account to Beta Bank's reserve account. Here we see a possible justification for the interest rate because Alpha Bank may be losing money through lost interest accruing on the money in its reserve account. Note that, however, this interest payment on reserves is quite a new thing, having started since the 2008 financial crisis. When C pays A transfer takes place in the opposite direction, and so now Alpha ends up with more money in the central bank account, and so is making more money from its reserve account, and also money from the loan to A. This looks like double dipping by the banking system on the economic activity generated by the loan. I have to say it's quite difficult to get a clear idea of how banking payments are processed, such that you might justify the interest payment on money created by Alpha Bank. It feels like the bank is charging for what might be a worst-case scenario on every loan. Of course, it's possible I've missed something in the processing of payments that brings the loan amount into contact with the Bank of England base rate and thus justifies a proportion-based interest rate on a bank-created loan. If you're able to explain this, please let me know in the comments. To summarise the points so far, investment banks borrow money to loan. It's not clear how the Bank of England base rate relates to the interest rates for such loans, and it's possible that the Bank of England is directing an unintentional cartel. Commercial banks, on the other hand, create money to fulfil loans. But yet again, it's not clear how the Bank of England base rate directly affects the interest rates for such loans. Why does the bank get 10 times as much money for an extra zero in a spreadsheet? It seems at least the bank is always charging the best rate for them, and it's quite clear that not all loans encounter a charge to justify this rate. Final point here is, why are the commercial banks getting to create such money? And why are they deciding who can get it? It is this last point that is addressed by the book Modernising Money, and its main thesis is that the commercial bank's ability to create money is a major issue with our money system, and that it should be reformed. In particular, taking away the ability of these banks to create money. In my video on tax, I discussed the ideas of modern monetary theory and summarised them with this diagram. Money creation is authorised by the government and directed into the economy by the government. Money is to catalyse economic activity by individuals and organisations in society, and FC is the total amount of money circulating in the economy. Money can be removed from the economy, for example to control inflation, through taxation, where it is destroyed. Clearly, as described, commercial banks are authorised by the government to create money, but it is they that get to direct that money into the economy, and the money only gets destroyed when the loan is repaid. How much of the circulating money, FC, enters the economy through the commercial bank loans? In the UK, about 3% of FC is the notes and coins in your pocket, created at the direction of the government. How much of the rest is created by the commercial banks? Well, it's all of it. That is, the other 97% all originates with the commercial bank loans I've been describing. The government has little direct say in how much money is created and introduced into the economy. This does lead to the amusing conundrum, If almost all the money in the system comes from loans, where does the money come from to pay the interest on those loans? Anyway, given this observation, we could thus redraw our diagram to represent things as they currently are, which I'll call a commercial money system. Almost all the money in the economy comes from the commercial banks and only gets destroyed when the loan is repaid. Let's take a quick look at how things work in this commercial money system. Here, Alpha Bank makes a loan to an entity, which it may increase the amount of circulating money. The entity uses that money to pay a vendor, but that vendor may use part of that to repay a loan, if, for example, this was a house purchase. The vendor might use what's left over for other purchases. However, if this house was not a principal residence, then they would also be liable for capital gains tax. In this case, the tax would be collected for the government to then spend. What about the need to control inflation caused by introducing new money into the system? Well, in this system, the removal of money only occurs when a loan is repaid. That means control must be on the creation side of money, that is, by controlling the creation of commercial bank loans. The only way for government to do that currently is through interest rate control, but that is a power vested with the Bank of England, not the government itself, which only provides the bank with targets. So a commercial money system seems to be firmly in the hands of commercial interests, with the government of the day only trying to influence that operation with indirect methods. Modernising money proposes to drastically alter the commercial money system by taking away money creation power from those banks and vesting that with a money creation committee, as shown in this diagram. Since the committee also decides how much money is removed from society, it seems to me that such a proposal brings us closer to operating our money system according to the ground rules of modern monetary theory. Having created money, according to various criteria set by the government, that created money is distributed for use in society, perhaps some distributed to the commercial banks for their use. I haven't looked deeply into the proposal, but the book goes into some detail about how to move from the current commercial bank money system to this nearly sovereign money system, so have a read if you're interested. The authors have made the book freely available from their website, which is linked in the description. So, in summary of the latter half of this presentation, about 97% of all circulating money has been created by the commercial banks. These banks decide how much and where this created money is deployed. Modernising money proposes how to change the system. Take creation power away from the banks, create a body to create and remove circulating money. This, to my mind, takes the banking system much closer to the sovereign money system I've previously described. Thank you for watching. Comments, questions, corrections in the comments section as usual.